Death and taxes. They're the two inevitable things in life, according to Benjamin Franklin, and wise man that he was pretty much spot on with that statement. But there are a lot of things we can do to control how much we pay in taxes, and there are also some things we can do to control a little bit about how long we live our lives, and hopefully that's something that we live a good, long, rich, and fulfilled life. But in the meantime, what I am here to talk to you about today is how we can control, in a very direct degree, our taxes. And in today's video, we're going to talk about the big one. That is, the big Roth conversion. Hi, I'm John Norberg, and welcome to the Financial Prof series. So the big one, what do I mean by this? Well, working with a lot of people across a lot of different backgrounds, we've done Roth conversions here at our practice for a long time. It's a really neat tax technique, which, just as a quick refresher, works by taking assets in as small or as large a degree as you choose from your pre-tax allocation, for instance your 401k, traditional SEP, simple IRA, and converting that to a post-tax IRA. You pay taxes when you do the conversion, and when you take that money out of the Roth IRA years down the road, it's completely tax-free, along with any growth that it's had in the meantime. A really neat way, again, to be able to tell the IRS when, how much, and in what manner you're going to pay taxes. One of the only times in your life you're able to control those factors, right? A lot of the time, though, when we as financial planners talk about Roth conversions, we talk about it in terms of bite-sized chunks. You know, let's take $15,000, $25,000, maybe as much as $50,000 or $60,000, and convert that from a pre-tax to a post-tax Roth IRA, right? And that can be good, and for a lot of people that makes a lot of sense. But what you want to consider, maybe, especially if you're in the top tax bracket and foresee being there for a good long time, possibly the rest of your life, is a situation like this, where instead of piecing it up and taking bite-sized chunks over the course of a series of years in that pre-tax to post-tax IRA conversion process, you do so all at once. You take that entire pre-tax IRA, 401k, whatever it is, chunk of money and convert it to a post-tax Roth IRA. But John, I can hear you saying, won't I pay taxes through the nose? And yes, in the year you do it, you probably will. But the fact of the matter is that in so doing, if you are already in the top tax bracket, there are a few important considerations you're going to want to think about here, right? And I'm going to go through those just so you can have a little bit of food for thought as you're mulling over whether this might be something to consider here in 2025 or beyond. So first and foremost, right now in 2025, tax brackets, thanks to the Tax Cuts and Jobs Act, which appears to be going nowhere now that we have some clarity around the presidential election, gave us a tax code which, for most people in most situations, is about as low as we've ever seen it, especially when you get to the top end of those brackets, right? If we look over the last 100 years of the US tax code from a federal perspective, this is about as low as it goes, ladies and gents. So first and foremost, if you're in that top tax bracket, chances are it's not going to go a whole heck of a lot lower, if it ever will at all. If you're in the top bracket, then why not, especially if you have some time yet to go until you would potentially be drawing out those Roth assets, and maybe it's an estate planning technique where you don't ever intend to draw those out because you have other assets like your business or proceeds from a business sale that you intend to use for purposes of income throughout the rest of your life. Why not take that hit? Here, what we have control over, here where we know that the tax brackets are about as low as they've ever been over the last century, and use that as a tool to make our assets now take that one-time tax hit and grow potentially on a substantial basis over the coming years. So this is especially worth consideration if you remember that just a couple of short years ago, Congress had the Roth conversion technique as a whole on the chopping block. They were very, very close to taking away that tool entirely to where Roth conversions wouldn't be available anymore for anyone, regardless of income or asset size, right? But as it is, right now, they are very much on the table, they are very much available to us, and let's go through a little bit of a case study about what this could look like, right? So let's say we have $2 million in pre-tax assets spread across a couple of 401ks, maybe between yourself and your spouse, between a couple of IRAs perhaps, SEP, and maybe traditional, whatever the case may be. $2 million, right? Now, let's say we convert that entire $2 million chunk, the big one, right? And we make that all Roth. we pay taxes when we do the conversion, so assuming a 37% top tax bracket, that means that 37% of that amount is going to go to the IRS. When you pay taxes on it, that's going to mean $740,000. And by the way, if you're doing this earlier in the year, you're going to want to be aware that, especially if you don't have any withholdings to account for that, that you're paying that on a quarterly basis so that the IRS doesn't ding you with a massive penalty the next time it comes around. Anyway, $2 million, $740,000 federal tax bill. Now, if you're in a state which, like Maryland, has a state income tax bill, you're probably paying some additional tax on top of that to state. And there are a few other things to consider as well if you're retired. For instance, IRMA and Medicaid, Medicare premiums, right? This is just a simplified version, right? $740,000 goes to federal government, possibly some to state, and a few other possibilities as well. But what happens next? This is where the magic starts to happen. So you've got, at that point, $1.26 million if, as in our case study, you withheld that $740,000 from that conversion. So in other words, $1.26 million ended up in your Roth because the $740,000 came out in the meantime, right? And got paid to the IRS. That $1.26 million, assuming a 7% rate of growth, which given recent decades on the stock market seems quite reasonable, could become potentially $2.52 million in about a decade, right? Given another decade, that $2.52 million could become as much as $5.04 million, again, assuming that same 7% rate of growth, right? And if you still had more time yet where you didn't take that money out and you just let it grow, you could be looking at over $10 million of tax-free money, assuming a 7% rate of growth over the course of about 30 years, right? And this is just using the rule of 72 that we talked about in a previous video to determine how quickly it takes your money to grow, which, again, assuming a 7% rate of growth, your money probably doubles about every 10 years, right? So if you start with $1.26 million, after 30 years, you could be looking at 8 digits potentially of tax-free wealth. That's pretty substantially amazing, and it becomes even more powerful if you are contributing along the way, right? Because in this case study, we're assuming that you didn't do any further contributions. But if you do, obviously that just compounds it in the meantime. It also doesn't take into account if Congress raises the tax rates in the future. If tax brackets in future years, as they seem likely to do, even if it's not the next couple, perhaps the couple years after that, do go up and maintain more of a historical average, then you're saving even more money, because at that point you would be paying even more if you did this conversion or pieced it up along the way, right? And if you're already going to be paying at the top tax bracket anyway for the rest of your life, why not take that hit right now and make sure that you pay that tax when the bracket is about as low as it's ever been, right? Okay, one last case study, because this video is already getting a little long. Let's say you've got $1 million in a pre-tax IRA, 401k, whatever it is, right? And you convert that to Roth. But this time, you pay those taxes with an outside account. You know, maybe you sold a property, maybe you sold a business, maybe you have a nice sized joint account between yourself and your spouse that's done really well, and you've got some money to burn. In doing so, that $1 million doubles to $2 million, assuming a 7% rate of growth and about a 10-year window of growth, right? Using that rule of 72. You've paid $370,000 in taxes, right, to a federal perspective, and you've grown that money potentially by about double. So now you're looking at 10 years down the road, $2 million of completely tax-free wealth. You have $1 million that you just made simply by taking that one step that is completely tax-free for the rest of your life, and by the way, for your beneficiaries' lives, if you do decide to pass that on as an estate planning tool. If you had another 10 years, simple math, that $2 million becomes $4 million. Over the course of 30 years, that could become $8 million, right? Based on that initial $1 million Roth conversion that you paid the taxes from an outside source. This goes to show you the power of tax planning and how important it can be, especially in a perspective where, you know, you are a very successful individual. You are rich, right? And you're paying a lot of taxes to the US government, which, you know, is as well as it should be. But I always advocate, let's pay what we owe, but not leave the IRS a tip. And using techniques like these, which are perfectly legal, ethical, moral, etc., we can then reduce whatever excess we might have otherwise paid along the way, making our life and our lifestyle, therefore, as tax efficient as possible by using techniques like this. So if you're interested in learning more about how the big one could make sense for you, and if you want to plot out what that could look like for your particular situation, drop us a line. And in the meantime, give a like and a subscribe so you never miss another update. Thanks, and in the meantime, I'll see you out there.